Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard, and we're live at the Star, the Dallas Cowboys headquarters. And Victor, I've got a question regarding the Dallas Cowboys headquarters.
Yes, I'm a true patriot and an American. I'm a Cowboys fan.
I know that the rent is relatively inexpensive here because you can watch the players practice when they practice. Is the rent, like interest rates tied to T-bills, and, you have different things that are kind of a baseline. Is the rent here tied to their performance? Like, if they don't do well, do we get a discount in our rent? If we don't get the advantage of being at the Star, do they cut us some slack? How does that work?
No, pretty much we get charged the highest rent in the world, regardless of what it is.
Win, lose, or draw.
That's right.
That's right.
Jerry didn't have enough money, so I want to make sure he had a little bit extra there.
But the Cowboys do stand with their hand over their heart for the anthem, don't they?
That's right. That's right.
There you go.
Being a veteran myself, that's very important.
There's some value there.
For those of you new to the show, we developed this show, 20-something years ago. And we've done it a little differently than some. Most shows, basically, it's an hour-long sales pitch about come to a seminar, do a managed program, an annuity, or some life insurance, something like that. We try to tell you, we have more credentials than most advisors. We've been doing this, how long? I've been doing it 31 years. How about you? 35?
Just about that, yeah. Pretty soon you don't want to brag about it anymore.
I know, it was really good till I got over 30.
Yeah,
then you're like,
30 plus.
I'm showing them old now. Right?
That's right.
But we've been doing it a little differently. We'll try to talk about every kind of investment, the good, the bad, and the ugly. Because sometimes investment looks fantastic. When you look up under the hood, it's not so great. Now, sometimes it might appear not so great. You look under the hood, and it's not too bad.
And if you don't do this every single day, if it's not what you do, it's hard to recognize. When people ask me, and when I talk to some of the folks on the phone for the first time that call in from the show, I tell them we're kind of a hybrid, between being consumer advocates. We warn about the life settlements. It's a little bit late now. Everyone knows about it. Yep. But the things where they promise you 24 or 25% interest units that are secured, the unregistered REITs, the things that you can't get out of, and also providing a good, solid, strong philosophy. Ours is the three buckets, right? Liquidity, income, and growth and inflation hedge. So it's kind of a hybrid thing, wouldn't you say?
Oh, yeah. It's like the life settlement stuff. Everybody was touting that stuff, and we were telling you to stay away from it.
Because they were getting promised high returns.
Years before they fell apart.
That's right.
Same thing with the private REITs right now. REITs are real estate investment trusts.
Right.
And a lot of people saying these are 10% or 20% units, secure units.
Secure units.
Secured by real estate that could be marked up 300% because there's no law. It's private investment, whatever it is.
Sounds like guaranteed, doesn't
Instead
it?
Instead of a certain percentage of rent, let's say it's 2% of rent, we can charge 20 because it's private. And if you want out, too bad, you can never get out because we call the shots because it's private.
And there's some other things they're just little subtle things, but you don't think about it. One of the commercials, won't mention the name, says, we do well when you do well. So now you're thinking they only make money when you make money. No, they make money when you lose money. They just do better when you do better because you've got more money in your account. Doesn't sound that way, though, does it? It's perfectly worded. We do well. Our fee structures are structured so that we do well when you do well.
What we try to do is break down different things. There was a thing about somebody said, well, fee-based is the only way to go, just what Guy was talking about. And this commission-based is the devil's work.
Right.
Well, we run detailed analysis to say, well, it depends.
A lot.
If you're going to hold it more than a few years, fee-based actually is way more expensive than commission-based, especially if you can get commission-based where you don't actually have to pay it.
Out of pocket, that's right.
So there's some things you just got to look at. Remember, I was a nuclear chemist for the military for a lot of years. It's just math. Math. A sales pitch can highlight the highs and not even mention the lows. But the math never lies. You put the math in, and that's why we have the most comprehensive retirement planning software that I'm aware of. If I find another one, I'll be using that too.
That's right.
But it can individually take groceries. Groceries really don't go up with inflation. Otherwise, a loaf of bread would be, $200 a loaf. But some things go up more, like medical inflation's gone up 7.5%
Quite
the
a
last
bit
20
more.
years. So we can actually dial that in when most financial planning, retirement planning softwares are giving you just a base number, which sometimes works, sometimes doesn't. It doesn't put real into effect. I'll give you an example. They'll use an average market of 10%, and they use it on everyone. So if you do above average, I think they're using probably 12%, right? Below average, maybe 7 or 8.
Either way, that's a good scenario.
That's right. But the problem is the market's averaged less than 5%
If
for the
you
last
didn't pay
century.
fees, that's right.
Yeah. So a lot of that stuff you have to dial in to be a little more detailed, and that's why we offer that no cost, no obligation to all of our listeners, and like I said, we've been on this radio for 20-something years. Call us at 972-715-2424.
And sorry about that. And along with that, something we do day in and day out, we talked about this a little bit last week. The number one reason economists, PhDs, Nobel Prize winners in economics tell you the number one reason for you to have an advisor, someone like ourselves, to keep you on track, is because of what's called behavioral finance. We're unplugged. We're a step away from it. You're very close to it. And I'll give you a quick example. This week, there's been some good news for the market, saying that the market's going to continue to go. And there's been some bad news. The bad news isn't that bad, but the good news is every year after midterm elections has gone up, with the last time it went down was 1946. That would tell you that the market's going to go up. I should probably load up or certainly not rebalance like I should be, because then I'll be losing money.
Right.
The downside is right now consumer confidence is at its highest level. And when consumer confidence is at its highest level, what happens? It doesn't have much further to go because everyone's there.
Goes the other way.
Everyone is in. So what do you do? Which one of those two pieces of advice do you take?
Well, also, we're in record territory. The market's never gone up 8 years in a row. It's gone up 8, and it's gone up 9. And if it does that through the midterms, it'll be 10.
That's right.
So you're on borrowed time either way.
And it could happen. I mean, there's always a first. That's what the market does. You plan based on what it's done, and then it does something you didn't plan for.
One of our advisors was talking to one of their clients here recently, and they said, well, they only do real estate, and real estate's I got 100% in real estate, and I know it's much better than everything you do. Blah, blah, blah.
Tangible, I got it.
And I said, well, if you've been around long enough, like I have, you've seen real estate go up and down. The first inkling of it was recently. They came up with an article. We have the highest amount of houses on for sale.
Inventory?
Yeah, highest inventory in 6 years. There's one thing that makes things go up or down. It's stock market, real estate, anything.
Supply.
It's not enough supply and high demand. So what happens when the supply goes up? Demand goes down. And it happens to everything. I hear people all the time saying, no, price earnings ratios, alpha, blah, 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 is what makes the market go up. More buyers than sellers is what makes everything on the planet go up.
Liquidity.
You have more sellers than buyers, it goes down. Like, we've talked about this. Sometimes we collect guns, it's kind of our thing, right? And I don't know what you're talking about. If we buy one that's really popular, you can resell it, right? Buy one that's not popular, no.
I don't know what you're talking about.
Oh, we're trying to say we're not right wing now. But those are the kind of things we do.
I'm trying to get Victor to say we more instead of I, and now he chooses to say we. Thanks, buddy.
Remember, the most comprehensive retirement plan I know. There's no cost, no obligation. Yeah. It takes us hours to prepare one of these, but we do that for all our listeners. The number to get that, take advantage of that, is 972-960-8700. Again, 972-960-8700. There's another thing we always include, or you can separate if you want, is a Social Security optimization program. That one will take your Social Security and tell you the actual raw numbers. There's so much out there when you'll see a person that says, I'm going to take my Social Security at 62. Then everybody else says, you got to take it at 70. It is actually different for different people, and this will vet it out. It depends on the age difference between you and your spouse, the income disparity between you and your spouse. There's all kinds of factors.
It'll show you the dollar amount difference, which is what you need to make the decision.
And people, when they do things, they always do simple math. Simple math says, okay, if I'm 62, by the time I got my money back, I'd be 78. No way. Nobody lives past 80 in my family. That's a ripoff. I'm taking it now.
Yep.
But they forget cost of living adjustment.
In case they go broke.
That's right. They forget all of those different things. Plus, they also forget if you die or your spouse dies, the largest one is kept. So if the largest one is a 62 number, your spouse ain't going to have much if you croak. That's
right.
just the way it is. So if you both of them are taking a 62 Social Security, there's not going to be much left if one of you dies. And so those are the kind of things you have to do. But the analyzer, there's once again no cost, no obligation. We'll show you all of those things. Don't hesitate to call us. We'll be more than happy to set you up with that. 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. We've got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
All right. Well, this is a fact instead of a sales pitch.
I like it.
Social Security is going to screw us again this year.
And what are you referring to, my friend?
Well, last year, I'll just give you a little history. Last year, we didn't have much increase for a few years, right?
That's correct.
So last year, 2018, where it's actually this year, they raised it by 2%. Pretty good, or 1.7%, something like that. But they forgot to tell you they raised Medicare premiums like $25, which wiped it all out.
That's right.
Okay.
The government giveth and the government taketh away.
Well, as of just a little while ago, they said they're going to expect a 3% increase this year.
Nice.
3%.
How much?
And then they just changed it a month later to 2.8%. So they're already down. And they're going to have an increase in Medicare premiums again by maybe only $15 this time. So if the average person went up, like, say, $39,
right,
he'd still be a net $25, something like that, right?
I know
it's not a lot, but hey, it's better than nothing, right?
Yeah.
I'm telling you, have you ever done like our Social Security optimizer, you see, and you do add a couple percent to it over time, it does become a pretty good number later.
And in fairness, we've talked about this a lot too. If you really look at, you go to ssa.gov. If you haven't logged in and registered, do so. Right. Look at what you've paid in and times out how much you're going to get back and how long it takes you to get back what you put in. You'll probably be really surprised. It is a good deal.
Right. The one thing that's interesting is, remember we talked about right before the break that people don't realize with cost of living adjustments and all that, and plus their highest Social Security is going to stay in case one of them passes away. So many people, it's like 70% of people take Social Security early. And I get it. It's bird in the hand, theory. It's not going to be there, blah, blah, blah. The truth is, I was just dealing with an 88-year-old couple, and the husband passed away just recently, very recently. And I was like, okay, well, the wife still gets Social Security. How much is it? $1,100 and something.
Yeah.
And that's because they
62?
took it. So that's right. They took it, and it was before these cost of living adjustments. Now 62 for a higher income earner might be, $2,000.
Sure.
Back then it might have been $900, $800. Wow. But now by the time this person's 88 years old.
And they've had a lot of increase.
That's right. And it's only $1,100. So this kind of thing happens. You got to remember, it's not just that simple math equation where you delay Social Security. If you take it at 62, it takes you 78 or whatever to break even. That's without cost of living adjustment. We put that in there, it might be 74, 75. But also, remember, you're doing this for two people. Unless both of you are max income earners, and it's not going to make much of a difference. But if you're not, there's a disparity when you and your spouse, you want to get one of them as high as you can, because that's the one that's going to keep going with you if one happens to somebody.
And you used to be able to do a lot of neat little tricks, file and suspend, and a lot of things. Now you still can do some of those, but that was quite limited as of about a year ago.
Yeah, they got rid of that stuff. They're going to keep. Somebody asked me about Medicare all the time. They're going to keep raising it.
Absolutely.
Right now, higher income earners pay for the Medicare like $187 to $428, plus you pay like $134 for the Part A. It gets nasty, right?
I'm curious to see how these medical co-ops and a few things that have several successful working plans across our country, and the government's looking at them and thinking about adopting and moving that way. And I know it takes a long time, but it holds out some hope.
Right. Well, you see, you got to pay those. Let's say you make a decent amount of retirement, you're paying $400 or $500 for Medicare Part A and B or whatever.
Right.
Try to find somebody in Dallas, Frisco, where we're at here at the Star. Find somebody that'll just take Medicare.
No.
My mother-in-law, it just has
They
Medicare.
refuse you.
They will not take you.
I'm going to take my mom. Nope, we don't take Medicare. Don't want to deal with it.
Now, if you have a supplement plan, all they see is Blue Cross Blue Shield, Aetna, or whatever. And what happened in Blue Cross Blue Shield is billing the government for the big stuff, and they're taking the little stuff. Well, they have no problem with that because a doctor wants to get paid in a timely manner, not get knocked down. And so nobody wants to take it. They know how long the government takes to do anything, right? Nobody wants to deal with that, but they don't mind. So, because we know everybody has Medicare at a certain time, unless you're still working past 65, right? You still have Medicare. But the point I'm making is you need a supplement policy. And so you're going to have to pay a few $100 for supplement policy, even on top of the $100 to $500 you're paying for Medicare A and B, because nobody will take it. I found some in a rundown part of town from a mother-in-law and one that's close. All the rest of them, I had to go out in the country to find doctors that will see her.
Yeah, and they were probably more reasonable too, right?
Oh, yeah. They deal with it every day. They don't have a choice. There's, it's either no insurance or you got this Medicare. Which one you want, Doc?
You need to add
in
that.
Dallas, they have a choice.
You need to add that to your axis of evil because the doctors overcharge, knowing that the insurance companies are going to knock them back. Right. So they charge way more. They get the maximum out of the insurance company, and a lot of them come back to the patient to get the rest still.
Right. I mean, I've got doctors that are friends and clients and things, and I always thought, well, it's got to be the insurance companies screwing these people. But until I got a $16,000 bill for a half-day surgery. It was a day surgery at a hospital. It actually went to a hospital. It was one of those.
That wasn't a kidney surgery, was it?
No. That was several days. That was a lot more money.
Yeah.
But I got a bill for $16,000. That's not the doctor bill. That's not the surgeon. That's not the anesthesiologist or anything. Facility. It was just the facility for 4 hours. Now I go, wait a minute. I get it. You have to have skilled nurses here. You have to have doctors here in the facilities. I bet the insurance is crazy. But $16,000 for 4 hours, don't you think that's a little much? And so
you thought the Star was expensive.
Holy moly. And so when you start dealing in numbers like that,
and that's the hardest thing.
Yeah, don't hate me, doctors. I'm just saying this ain't the doctor. It's actually a facility. The doctors are good, right? Facilities are bad.
Back into retirement. That's the hardest thing to plan for. How do you come up with a number in retirement when we're doing our retirement analyzers for medical expenses?
20 years, medical expenses have gone up over 400%. Yeah,
it's hard.
You can't. I never paid health insurance like I did now. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Oh, by the way, I'm a very young person with 30 years experience.
You started at what, 5?
That's right. That's exactly right.
You were a child prodigy.
I think my 32-year-old son would.
You said you were reading the Wall Street Journal at like 2, didn't you?
No, my dad made me read the Wall Street Journal at 10.
Okay.
I thought he was a Nazi war criminal or something. You have to be terrible. They would give me these things to recite, and I'm like, I knew it. Obviously worked out. I'm a financial advisor, so was he for a long time. But at the time, I was like, how do you torture a kid? This must be chapter 1 of your torture a kid book.
I can tell you that one of the worst punishments I ever got when I forgot what I did. I think I came home from school a half hour late. I was sliding down the hill and got my pants all muddy. I had to write. My mom made me write the 119th chapter of Psalms. If you're familiar with the Bible, that thing is the longest. It took me weeks sitting at the dining room table, handwriting that out.
Let me ask you this.
I learned a lot, but it was brutal.
Did you ever do anything with your pants? I mean, did you ever dirty your pants?
I think she probably had to throw those away. They were probably all muddy and nasty.
That's obviously extreme, but I'll tell you what, nowadays, we gripe about millennials and all that stuff. Yeah. We're the ones that raised them.
That's right.
Because we didn't want them to do the stuff that we,
exactly.
We didn't have to go through that stuff. That was a little too harsh. But by not doing that, here's what we got.
Well, and everything's a pendulum, right? So it's going to swing back. Wait till they raise kids.
Oh, no. I interview people and I would rather not be held to any kind of hour system. I can work more on my own without any schedules or...
We were talking about it just the other day. We got a request for a spouse's birthday off. Now, we never got our birthdays off. So now, not only do you get your birthdays off, apparently you get your spouse's birthday off, too. How does that work?
Oh, no. They said, I require 30 paid days off a year. I'm like, well, who are you, Mr. President? I mean, Is that where you start a job? But this is what it was. I didn't take a vacation for like the first 10 or 15 years of doing this. You know, now I take at least one a year.
That's right.
It's not bad. All right.
So we were solving the medical crisis in America prior to going to break.
Right. Just listen to us. We'll solve all the crises.
That's right.
Let me talk about this. There's all kinds of different theories and strategies regarding investing, right? Some people say, I'm not going to invest in anything. I only want CDs, bonds, something safe, you know. Some people say it's all stocks all day. And then some people say, I like a brokered, mutual funds that are actively traded. Other people say, no, that's ridiculous. You want to go indexing. Indexing is the way to go. Without talking about either one in too depth, it's hard to argue. Remember, we're math guys. It's hard to argue the value of indexing, especially when the market goes up 9 years. It makes you look really good, right?
Are they perfect? No.
No. I'll go, but indexing is interesting. So we know the negatives. If you just put all your money in indexing, we know the negatives. The positives are you don't have no fees, right? Or very low fees.
And you're pretty much 100% invested the whole time. You don't have cash on the side waiting to make a purchase.
Right. And there's ETF versus index fund. ETF can be sold any time of day.
Yep.
Any mutual fund has to be sold at 3 o'clock no matter when you put in the order.
No hidden fees.
That's right. So there's all kinds of things like that. I'm going to talk about an index for real quick and just to tell you, there are some indexes that have no fees, but they're also they're more actively traded. In other words, they're trying to take advantage of different disparities, economic conditions, things like that. In other words, if they feel interest rates are going to go up significantly, they're going to lower their thing of long bonds.
Their exposure to bonds, that's right.
Long bonds are going to get hurt real bad as interest rates go up like they are now. Okay, or vice versa. Now we've got interest rates peaking. The Fed announces we're going to cut them down 15 times in a row. Ho-ho, time to buy some bonds, right? Yeah. And so it does those kind of things. Or let's say, like right now, Italy is probably one of the weakest cogs in the European Union as far as economically.
Greece is right there.
Greece is there, but Greece's economy is 1/50th or something.
No, I understand.
Italy, so,
but it's still right there.
So let's say it's that. Well, if you just do an index, it's going to have a specific amount, if you're doing, let's say, a Euro index of Italy. Well, if you do it a little more actively managed, they're going to lower that percentage of Greece and Italy or whatever. Okay. If you remember, did you ever look at their retirement in Greece? It was like at 45 or 50 or something, and you got like full retirement.
All the Europeans, man.
It was pretty good.
4-day work weeks. Yeah.
I was like, I need to go over there, work for 5 years, retire, and then come back here and go to work again. Problem is, we're over the ages already, right? But I'll give you some of the index. So this is more of an actively traded index. It has 0 fees, right? There's no fees or whatever. Each individual one might have some little, but it's all absorbed into this particular product. But you got the S&P 500, Russell 2000, NASDAQ 100. You got the German index, the DAX. You got the FTSE, which is Great Britain. Then you've got Japan, which is the TOPIX. That's on the equity side. On the income side, you've got Japan bonds, German bonds, American bonds, and you got the different ones, 5-year, 10-year. Now, right now, they don't have anything over 10-year Treasury notes or Treasury bonds. Why? Because interest rates are going up. As interest rates going up, the longer the bond, the more risky it is. So that's why it shows you the benefit of taking a longer. On top of that, this particular index has some commodities. Bloomberg Energy Index, Bloomberg Industrials, and the Precious Metals Subindex. So you're kind of getting access to all these different indexes. They're going to adjust them based on economic conditions all in one product. We'll talk about that more when we return from the break. Stay with us, folks. Remember, if you have any financial questions, don't hesitate to call us at 972
715-2424. 972-715-2424.
Stay with us, folks. You're listening to the Common Sense Investing Show.
We'll be right back.
On News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome to the greatest financial show
in the
America.
Metroplex.
No, in America.
I'm sorry.
All right. I'm not sure if that's true. We're just kind of going with that one.
Let's run with
it. Let's use that one.
You know how to generate some phone calls. Maybe bad, but we'll generate some calls.
Now, we had, like I said, the one thing that I do, that there's probably 10 or 15 financial shows in Dallas. They're just there, and there has been. But there's only 2 or 3 that have had the staying power that we have.
Longevity.
I only know, actually, of one other one There was a couple other long-term ones, but they kind of went to the wayside. I don't know what happened to
A
them.
couple of them lost their licenses. just saying.
Yeah, a lot of them are not giving great advice. They were doing
No.
private investments, REITs, and private REITs and private, what do you call it? The
Life settlements.
Oh, yeah.
Life settlements.
They jumped on them.
Flipped a couple.
Good thing we never jumped on them. We told everybody not to do them.
Think about how many times they came to our offices
Oh.
and tried to tell us how stupid we were for not.
Oh, I know. They brought
Carrying.
their whole dog and pony show from Waco to tell
That's
me
right.
how dumb I was.
That's right.
And they knew I was ex-military, so they brought 2 retired officers from the Navy to talk to me.
Oh yeah.
I was like, well, how'd you dig this up? You found 2 retired officers? I said, I'm still not doing it.
That's right.
I go, I got a license and a reputation. They go, well, this will enhance your reputation.
Oh, yeah.
Well, apparently it didn't. For
A
these
lot of
people, it didn't, right?
That's right.
We're talking about indexing before. I agree, for stocks, indexing is tough to deal with. But what we're talking about is what if you had 15 different indexes that were included in a package, right? But this package didn't have any fees or anything like that, no commission, no loads or whatever. And you've got like 6 equity income classes, 5 or 6 income, and some commodities. So you're getting a broad diversification across all asset classes. What they do each month, they evaluate. They measure the 6 months return of all 15 asset classes. All right? And then they select the 9 with the greatest returns over the previous 6 months, and they strategically weight those indexes.
Concentrate.
And just to give you an example of the kind of returns we're talking about, this is just the index. You're talking about the market since 96 has made 6.39% a year. Remember, wasn't that 10% deal? From 2000 till now, we already talked about that many times. 4.97%. So 4.97 for this century. But if you go back, like, say, 20 years to 96, it's about 6.39. This index never had a down year because, remember, the diversification between fixed income, commodities, and all that. And it compounded at 6.51%. Okay? So what if I'll give you an example. In 2000 to 2002, remember those are 3 down years in a row. This would have made 6.3, 2.37, 6.74. Instead of the market in 2000 lost 10, lost 15 in 2001, lost 25 in 2002. Well, let's go more recently, like to 2008, the bad year. Market lost 38%. It was actually 55% from the high. Well, what did this one do in 2008? It made 4.27. So there's a value in diversifying different indexes. All right.
And it also, and one of the reasons that they came up with this is it took out the peaks and valleys by the way they did it.
Right. Well, let me give you an example. So let's say that is a pretty good index. In other words, diversified across asset classes and commodities and equities and bonds, right? And globally. And on top of that, it smooths out the ride. So you end up with a similar return to the market in the last 20 years, but a lot less of the downside. Now, let me say we did this and we put in a package together and we said, okay, not only are we going to give you that, I'm going to give you 120% of that return. 120%. Now, I can adjust that.
So if the market
percentage.
makes 10, I get 12. Is that
Exactly.
what we're saying? That's
exactly. Now, they can adjust that percentage. I've seen as low as 90, as high as 130, right? That's 120. So they can adjust that percentage every 3 years or so. Let's say it does that, okay? So you got a better return on the market. And on top of that, if it ever does go down, they'll guarantee you cannot take a loss ever. You're always going up, always moving forward. The worst you can do is have an even year. Remember, the market lost 50% twice in the last
57%.
18 years, right?
Yeah. No,
So if that ever occurs, you can't take a loss. What if I also told you we're going to make it tax deferred? You don't pay taxes on all the gains that are mounting up until you actually start spending the money or whatever. We're going to make it judgment proof. Let's say you're a doctor out there, and people love suing doctors. Nobody can sue you and touch us ever. Texas is one of the few states in the United States that is 100% judgment proof. And
meaning there's no dollar limit.
that's right. You can put $10 million, $100 million,
That's right.
and have it completely judgment proof. Biggest example I can ever use of that is in liberal California. OJ, we know he killed those people. Come on, let's be honest. It wasn't the glove didn't fit. It was the other 1,100 pieces of evidence that convinced me. I'm just saying. I digress. But what you've got is they never touched his pension, right? What we're talking about is a fixed index annuity.
They took his Heisman, though.
That's right.
Made him sell that
They
Heisman.
could take your mansion and your Bentley. He was still playing golf every day. $400,000 a year. They
He
can't
was
touch.
searching the golf courses worldwide looking for his wife's killer, is the way I understood
exactly
it.
right. So think about it. We talked about You get access to 15 different indexes, actively managed, trying to make sure it weights the indexes that are working the best now, underweights the others. So it's actively managed without any of the fees. If it ever takes a loss, you're guaranteed never to take a loss. So you're getting 120% of the up, none of the down, and it's tax deferred, and it's judgment proof, and it avoids probate. The problem is, it's called a fixed index annuity. Now, those are supposed to be terrible, aren't they?
Supposed to be brainwashed again.
That's
Now,
right.
understand, I know this sounds really too good to be true. The short version, and come in, we can take you through it step by step, but the short version is your money's guaranteed, it's protected. It is in 10-year bonds, and the interest that those bonds throw off allows a call option to be purchased to credit the
You're
interest.
buying options on an index, and this index
and
happens
that's
to
a
have,
short version,
that's right.
but it's really easy to walk
It's
you
like
through
an index of indexes. So they're buying an index on this index, which buys 15 other indexes.
Absolutely.
So you can get the access to the potential gains of equities, which everybody wants and needs, without the risk potential. Okay? But it's called something people don't like. I don't care if it's called dog sandwich. If it gives me indexes for no cost and guarantees against losses, tax deferred, judgment proof, it doesn't sound too bad.
And if a whole lot of people tell you not to do it,
Yeah.
it's kind of time to be suspicious.
And the returns on those, by the way, 6 to 8% after fees, after everything. Well, there are no fees, but 6 to 8%, which is not bad. Don't hesitate to call us. We'd be more than happy to send you a no obligation information kit. 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Earlier in the show, Guy mentioned something about behavioral finance.
Hey.
Actually, something I really am interested in. You know, how certain biases we have, how our normal behavior as human beings affect our financial decisions. And that's always been a really interesting topic for me. I'm like, oh, how does that work? You know, we all have our own biases, right?
Absolutely.
It's amazing to me, like, you know, looking at no matter who it is, no matter how unbiased they can be, they kind of always go in their own camp, right?
That's
They
right.
always think, because they're thinking through a certain filter, their own experiences or what they were taught, whatever. And they can be in different parts of the country, be fantastic people, good people on both sides, and have a completely different, you know, one news story, completely different idea, right?
Look at religion.
No, I know. So we
Everyone
know
that was
stuff.
brought up in their religion knows that their religion is the way.
Oh, yeah. Well, they're talking about, there was another article recently that I thought was pretty interesting. It's talking about financial markets. You know, we know what we're supposed to do, kind of. Doesn't mean we actually do it. Most people do exactly the opposite of what you should do. They'll sell when they're supposed to be buying, and they're buying when they're supposed to be selling. When does the most money come in the stock market? After a long bull market, when it should have been the opposite.
And
right?
at what price on a stock is a person the most comfortable to sell?
When it's down. No.
Usually what they paid for. When it's
Yeah,
up,
that's
they
true.
don't want to sell it because it's not going to ever
That's right.
stop. When it's down, you can't sell it because I'm going to lose money.
It's
and
going to cycle out your
I
hammer.
want to way back to where I get paid
That's
for
right.
it. That's right.
I always tell you, you're kind of in limbo. Well, I can't sell it. It's down now. I got to wait for it to come back up.
Absolutely.
Or if it's down, well, I got to get my money back. It's crazy.
That's
And you
right.
end up- but so the one thing he said, he goes, in financial stress, it is proven that people lose 13% of their IQ when it comes to doing.
How do you attach a number
I don't know. I
to
want
that?
to see this
That's
study.
pretty good.
But I thought that was pretty interesting.
13%.
13% of their IQ
Not
is
13
gone
points.
when
Wow.
it comes to financial stress because emotion starts taking over. Basically.
Sure.
All right. But they had a couple things. They said overconfidence is a big one. What do you see overconfidence in? Well, something's gone up for a while, right? Stock traders weren't that confident in 2008, were they?
No.
But boy, 10 years later, they're pretty dang confident, right? Stock investors, the same thing. Oh, this market scares the crap out of me in 2008. Not now. They say, oh, no, it should be. Real estate. Real estate hadn't gone down in years. That's bulletproof. There's no way it can go down. You don't understand. They're not making more land, son. You know how many times I've heard that in my 30-something years? A lot of times. But people they said, as a defense factor, they said especially men. When they surveyed men, all right, they said men find themselves friendlier, funnier, and better looking than average like 90-something% of the time. Apparently there's no ugly men.
Apparently. Just
They said-
ask us.
Right. They said the average man thinks He's 2 sit-ups away from dating a supermodel. That's pretty much what they do.
I feel sorry for the guys that are 2 sit-ups
away. Then you got natural conservatism. Here's what people do. We tend to stick with things we know. We have a tendency to stick with something that's worked in the past. And he said one of the top things to do is, what they think is, I know what to expect, so it'll hurt a little less even if it goes wrong, right? I get that. But they said sometimes you should do what you don't know and listen to a professional. Sometimes it just take a look. You take baby steps. I'm going to still keep 80% over here, but 20% I'm going to let you. Now, I'm going to keep a short leash on there. I'm just letting you know.
Right.
But you got to overcome these biases because personally, it is almost impossible to detach yourself from money. I heard this one analogy one time. Think about it. You can buy a book at the library right now, go online, and you can have a step-by-step report, not a report, but a book that says, here's how to operate on yourself. Now, so you could, I guess, feasibly do that, but it seems like a lot of pain, and maybe the guy that's doing it and putting you under is probably better qualified than that. But people, when it comes to their money, especially if they have a little experience in it, all that goes out the window. Nope, you don't understand. I'm a pilot, and we know more about finance. I go, well, you've seen one person's portfolio, right? He goes, yeah, that's right, my own, and I've done a great job. I don't need you. I said, all right. Well, don't you think you might benefit from the perspective of somebody that's seen thousands of portfolios over 30 years, and they know what he's showing you is they might know things that you don't know.
Absolutely.
Right? And so those kind of things, you got to take emotion out, but it is hard. The bias thing is what happens when the real estate has gone up 9-10 years in a row. That's when most people put it in there. Like right now, do you realize how many people are getting their real estate license the last 5 years? It is like 10 times more than having history or something. Now, wait a minute. Do they know something I don't know? Do they know something we don't know? Or are they chasing no, so-and-so was a housewife, now makes $15 million a year, and had no trading or whatever.
How many people do you think right now are just getting into the stock market? They've waited and said, I'm not going to wait any longer.
Or they're like, I had half my money in money market last year, didn't make a thing. My market made 24% last year, which is pretty normal.
I'm not doing that again.
That's right. I'm putting it all in the market after 9 years record going up. We know the Shiller PE ratio is 32, 33. It should be like 15, but that's okay. That doesn't matter. But some of that's true, though. Some of the market right now is being held by emotion. Whatever happens in Congress, the president, whatever, it's kind of going up on good news and not going down too much on bad news. Consumer sentiment's really high right now.
One thing about returns, we've noticed over 30 years, people don't know what they're making. The market averaged 4.9% this century. If you had no fees, what does the average investor make?
Like 2.
Well,
that's our show, folks. Remember, if you have any financial questions or you'd like to take advantage of our no-cost, no-obligation retirement plan, Social Security Optimizer, or talk about that index annuity we talked about, give us a call, 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.